Welcome to Yahoo Finance Live and happy Friday. I'm Shauna Smith alongside Dave Fraze, and let's get you up to speed on this market action as we wrap up the first quarter. Once again, you're looking at gains across the board. The Dow up 280 points, S&P up just about 1%. The Nasdaq leading the action today. That better than expected inflation print helping with today's sentiment. One of the biggest movers of the day and of the quarter is Tesla. The EV maker is expected to release its first quarter sales numbers over the weekend. We will tell you what you need to be watching for.
And a New York grand jury voting to indict former President Donald Trump. Trump reportedly facing more than 24 counts related to business fraud. This marks the first time ever a former U.S. president has been indicted on criminal charges. We'll tell you what it means for the state of play in Washington coming up. But first, let's get you up to speed on today's market action. Jared Blickery here to break down the action today, which continues through the quarter. For the week, it's just a lot of green on the board again.
Hey, I'm not complaining, Dave. We'll see what happens next week. Let's stick with today. As you can see, lots of green over here in the indices. Nasdaq leading the way up, about tied with the Russell 2000, the small cap indicator, 1 1/3%. And I want to show you what's happening with the VIX right now. The SIBO volatility index, the fear index, has come down to levels, some of the lowest levels of the year. I'll show a candlestick so you can see the actual. We've had some lower lows in February, but getting back down there. Also want to check out the bond market today. Are getting some movement in yields to the downside. The 10-year's down 5 basis points. The 5-year here down 4 basis points. And the 30-year, let's see, that's down about 5 as well. Now, inside the market, we're looking at consumer discretionary. That would be retail stocks. XLY in the leadership, the pole position up 2.33%, followed by communication services, real estate, materials, and tech, all of those outperforming. So we got the mega cap sectors in there. And let's just take a quick look at our leaders here. And we can see ARC Innovation Fund. That is in the leader there. 5%. So if we take a look inside, we're going to see Tesla. That's a big mover here. That's up 6%. And then take a look at some of the other ones. DNA up 10. These are all these disruption ones. Unity Software up 9. PD, the PagerDuty, that's up 7%. And let's go over to the Nasdaq. We already covered Tesla, but let's take a look at Alphabet here, up 2%. Really nice to see all this green on the screen here. And a lot of that is predicated or facilitated at least by those lower interest rates that we've been tracking. And that's kind of been the status and the case for the whole month. Let's take a look at the Dow, only seeing a little negative action in the staples and a couple healthcare stocks like Amgen. Travelers also down marginally, but for the most part, we're seeing broad-based gains here. Let's take a look at the regional banks, see if there's any weakness there. We do see some weakness, but a mixed board, guys.
Yes, certainly a lot of names in the green today. Jared Blickery, thanks so much. Let's get you up to speed on former President Trump's indictment by a New York grand jury. It's the first time in history that a former president has been criminally charged. Now, the charges have not yet been made public. Our legal reporter, Alexis Keenan, is following this story for us. And Alexis, there's lots of questions just about how exactly all of this is going to unfold.
Yeah, so we're just learning, though, in the last few minutes here that the judge has signed an order that says that the DA, Alvin Bragg, can go ahead and unseal this indictment. So we could see it sooner than we thought. Sometimes in New York, these indictments are held until the defendant is arraigned. But let's just take a step back here and go over what has transpired from last night up until today. At least 12 members of a grand jury in New York, they voted that there is enough evidence to charge Donald Trump with felonies specifically. Now, those are crimes that are punishable by over 1 year. Now, in New York, a grand jury votes is required in order to bring these felony charges unless the defendant waives that type of inquiry. Now, a juror's job is to really take a look at this evidence and decide if there is probable cause. And what that means is it's more likely, they think, than not that a crime has occurred. These jurors must be they must be in numbers of 16 to 23, but just 12 of them need to vote yes for an indictment. And also they have to be U.S. citizens and they have to reside in the county where this inquiry is taking place. Now, so far, that indictment, we haven't been able to see it, so we don't know what exactly the charges are. Apparently, Fox News has reported that Donald Trump's, one of his attorneys has said that they're expecting 34 counts of business fraud. And the way that his lawyer put it is that it's possibly 1 count of fraud for each hush money payment made to the film star Stormy Daniels that this is, of course, all about. Now, that shows us that there are separate payments totaling that $130,000, according to Trump's attorneys. But what's next is we can expect Trump to surrender. We're hearing that he will voluntarily surrender himself to New York authorities and that he'll be traveling from Florida to New York. And he will have to make a first appearance and he will have to be arraigned, meaning he will have to be apprised of the charges that he is facing. Those could happen in the same hearing before the court. He will be asked to enter a plea after that time. He will also be booked. He will get a mugshot. He will be fingerprinted. So this is serious a matter taking place here. We will be watching on Monday and Tuesday to see how all of this unfolds. Meanwhile, Trump denies all of these potential accusations. He has repeatedly since 2016 denied that there was any encounter at all with Stormy Daniels.
And the American people had a lot of questions, including what's new, why now, what changed in the years since this first came to light. Yeah. Can't wait to get our eyes on that indictment. Alexis, thank you so much. Have a good weekend. While the markets have appeared to brush off the indictment of former President Trump, what are the greater implications for the economy, the 2024 race, and of course, our political gridlock? Political strategist Rick Wilson is the co-founder of the Lincoln Project. He joins us now. Good to see you as always, sir. So
Thank you.
Cannot believe I'm asking this question, but I am. Does this change a single vote?
Not a damn thing. Look, if anything, it makes it much more likely Donald Trump wins the nomination for president in 2024 for the Republican Party. The party, as you can see, from top to bottom has been rallying around him. Even his alleged opponents in the presidential primary, like Ron DeSantis, are all bending the knee and contorting themselves into, pretzels to try to say, oh, I'll protect the Donald better than you'll protect the Donald. It's an absurdity. But it really shows you the centrality of Donald Trump inside the Republican Party. It shows you the sort of black hole effect that he sucks every bit of political attention toward him. And look, there's a part of Donald Trump right now who loves what's happening. And people should understand that. There's a part of him that does not care about being arrested, that does not care about being indicted. It brought the spotlight back to him with an intensity he hasn't had in a very long time. And he understands the political benefits of it. His super PAC is going to raise a ton of money. His campaign is going to raise a ton of money. He's going to go out there and he's going to thumbs up as he walks up to the courthouse, and he's going to grin when he gets his mugshot. And this is a guy who understands the showmanship aspect of this. And so what it does is locks in the Republican base. It locks in the Democratic vote. And if the Democrats are smart right now, they're going to want to freeze the election in place so that Joe Biden has a year plus to get boosted up, and that Donald Trump becomes the hallmark of everything about the Republicans that has disappeared in the past years. Rule of law, the Constitution, adherence to individual responsibility, that's out the window.
So, Rick, you clearly think it's going to help his popularity, obviously, within his own party. What about the general election? If, of course, former President Trump does get the GOP nomination, could it potentially help President Biden if he runs again in 2024?
I think in the general election, we at the Lincoln Project identified a group of voters back in 2020 called the Bannon line voters. That was about 3 to 8% of the Republican Party, depending on the state, that could be persuaded away from Trump. We know from our research and a lot of other research that number has expanded pretty dramatically. It's basically doubled in the last 2 years. We believe that as this drags on, there will be more of those soft Republican voters, more of those independent-leaning conservative voters who are going to say, I'm done. I'm done with this thing. We also think it will help the Democrats solidify their vote, because even the progressives who don't love Joe Biden are starting to realize that we can't take chances allowing Donald Trump to come back into the White House. It's a matter of the best being the enemy of the good. And if Donald Trump faces an electorate where there are fewer hard Republicans and a more solidified Democratic Party, I like the odds for the country. But it is an election now we cannot take lightly. This is a real signal that an existential election for the future of this country is coming at us very quickly.
In the meantime, you referenced the money angle. Do you think this is something the Trump campaign will literally directly fundraise off of this, message it?
They already
perhaps
are.
use...
They are already doing it. Yeah, they're out there already. I've seen 2 emails come out in the last 24 hours, and I'm not on every one of these lists, and there are a lot of them. They are already raising money off of it. They are already out there using this, to beat the drum. Oh, Donald Trump, the martyr of the deep state, needs your help. And this is going to be something that you see Trump weaponize very quickly on the financial side. And remember, this is the most successful business Donald Trump has ever run. The email scam grift business that he runs is the most successful financial operation he's ever engaged in his life, bar none. And so he's going to do that at a level we think that will re-engage a lot of the small dollar online donors that had drifted away a little bit from him and were sort of flirting with Ron DeSantis and other candidates. We think that's going to lock those folks back in.
So if he drums up a lot of support here within the Republican Party, what does that do to what has already clearly been a very divided government, even over the next 2 years? Is it going to push the two sides even further apart?
Well, I think you end up in a situation where the partisan incentive structure on the Republican Party side of it is to do everything you can, perform every stunt, every legislative trick, every committee hearing, every showboating moment you can to support Trump. You've seen the leadership of the Republican Party in the House in particular in the last 24 hours. I believe to this date, I've seen one member of the Republican caucus tweet something that wasn't a complete defense of Trump and, calling on Alvin Bragg to be taken out in the street and fired that day and all, et cetera. So this is going to shape everything they do. They're going to go with since Republicans are always in the business of projection, this weaponizing government thing that they claim happens to them, they're going to weaponize the government against the Department of Justice, against the New York courts, against the courts in Georgia, anywhere else he faces a legal threat. They're going to use their power as members of Congress to try to drag those prosecutors in front of them, try to drag the DOJ folks in front of them, to try to torture them and pollute the cases as much as they can to reduce the legal liabilities and risk that Trump faces from them.
It is going to be an interesting couple of weeks ahead. Rick Wilson, thanks so much. Appreciate
yes.
that. Buckle up, my friend. Okay, let's do a quick check of the market, sponsored by Tasty Trade. Continue to see an awful lot of green on this board. You're looking at a Nasdaq up more than 15% in Q1, an S&P up between 5 and 6% in Q1. All three indexes positive for the week, and the leader here once again continues to be tech. Is the Nasdaq up 1.4%. Again, that's sponsored by Tasty Trade. We are just getting started here on Yahoo Finance Live. Coming up, Tesla shares on the rise. We'll tell you what could be in store when the company reports Q1 delivery numbers this weekend. And I'll be headed to the New York Stock Exchange to speak with NBA superstar Giannis Antetokounmpo and Calamos Investments CEO John Kadunis about how they're helping people invest for a brighter future. You don't want to miss that. Stick around.
The Nasdaq is set to close the quarter up nearly 15%. Technology and communication services leading the sector action. Two standout stocks within those sectors since the start of the year, Meta and Nvidia. And take a look at their performance since January 1st. You're looking at Meta soaring nearly 75%, right around 75%. Nvidia up nearly 90%. We want to bring in Carol Schleif, BMO Family Office's Chief Investment Officer. It's great to see you here. So what do you make of the rally that we've seen and really the fact that tech has been leading enough to think that that momentum's going to continue?
Well, it's been interesting looking at markets overall in the last year, but especially in this last month, the last couple of weeks. Tech, when you peel it apart, yes, a lot of the overall averages have come up because of a very few tech names. But I think it's ironic in that tech may be a defensive play in some people's minds. It's both a growth-oriented play as rates have come down, but it's also a piece of a defensive play given how beaten up the stocks were last year. When you're looking at who has cash on the balance sheet, who has less of a need to use the financing avenues that may or may not be available to broader industry, and who has reasonable prospects for participation going forward in terms of looking at as we rebuild this economy and put things back in order. And the economy overall is pretty strong. So given that beaten up nature, cash on the balance sheet, there's been a lot of call or a lot of rotation back into those. But it's important to remember that the economy overarchingly has a pretty solid base underneath it.
So Carol, then what's the next catalyst here to keep that momentum then intact?
I think the interesting thing is we need to see the momentum broaden out. It needs to not just stay in tech. And I think getting people to focus on the fact that we do have a lot of spending teed up in this economy that's aimed at very critical infrastructure. It's aimed at building out green technology, green grid, electronic vehicles. There's a lot of stuff that was teed up in three very distinct funding packages over the last year and a half that puts over $1 trillion, close to $1.5 trillion of funding and credits and things back into the environment. Tech will play a piece of that, but there's a lot of other industries that will participate in that as well, not the least of which is some of the industrial goods companies, some of the mining manufacturers and things like that. And you're seeing that. You saw it come through in the quarterly results last quarter. We should start seeing some of that or hearing some of that as we get earnings released beginning next week.
Carol, lots of focus here, obviously, on Fed policy. That's been the case now for quite some time. How much has a potential Fed pause or even a pivot by the end of the year, how much of that has already been priced in, given the gains that we've seen?
Well, I do think a fair amount of that's been priced in. And the most interesting thing in a long investment career has been seeing how hard the markets have been fighting the Fed commentary, because Chairman Powell and the crew have been very blatant about wanting to fight inflation. You have a little bit of optimism in today's numbers based on the PCE and some of the data that we've seen come in that seems to support the inflation having peaked narrative. But we do not believe that you'll see cuts this year, and the markets are clearly pricing in cuts by later in the year. And we do think that the Fed holds in here and watches as inflation comes down, because around the globe, inflation still stays higher than people want to see it.
Carol, what happens if that doesn't happen, if the Fed continues to raise? Could we potentially see a sell-off, and how bad could it get?
You could see a sell-off, and I think that's why our prognosis is that you'll see a range-bound market. It's been nice popping off the lows that we saw reached in January, February this year. But we feel like there's little to propel it distinctly skyward or distinctly the other direction either, and that we're likely to stay range bound. You could get some disappointment if inflation stabilizes in here or ticks up, or jobs market was to fall off dramatically, or tightening that's de facto likely to happen in some of the financing ability of a lot of these small and mid-sized companies as banks continue to struggle with making sure that they can profitably get loans out there.
There's certainly lots of questions as we enter the final 3 quarters of the year. Carol Schleif, great to have you. Thanks so much.
Thank you.
Well, coming up, the road ahead for Tesla. The EV maker expected to report its Q1 deliveries data this weekend. We will tell you why this report is a key driver for the stock next.
The consumer is resilient today. People are hopeful. And hopeful that they still can be prosperous in the future.
About 25 to 30% of your tenants are in fact tech, Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
We're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies.
The impending recession we keep hearing is 6 months out.
What kind of trends are you guys seeing right now?
Still seeing good consumer demand out there. The question will be, how does that consumer hold up as we get to the back half of this year? But if we see that consumer hang in like they have through the first part of the year, we'll have the ability to bring production on and serve whatever needs are there.
This is still a very young market. You know, we're still talking about fractions of people, and by the way, fractions of activity because of COVID.
Are you seeing any sort of deterioration in demand or differences in the decisions that people are making?
That's the flip side of this. There's some positivity for those who have some savings and investments, now can get a higher rate of return, even in FDIC-insured deposits, right? Yes. With money markets and CDs like they've not seen in over 15 years.
All right, let's take a look at Tesla because Tesla is expected to report its first quarter production and delivery numbers this weekend. And the report is usually a key driver for stock action. Josh Schaefer has been digging into what we've seen after past reports. What do you got for us?
Yeah, Shauna, so this is normally a moving day for Tesla. Normally the report comes over the weekend, as we're expecting it to come this weekend, and then it will move that following Monday. So the last time Tesla beat significantly was actually a little over a year ago, and that was Q4, or it was the Q4 deliveries. That came in January 2022, and that was sort of the start of that run there. The stock jumped about 10% that day. And then you fast forward to April of that year, and that was right before the big drop here. This is Elon offering to buy Twitter, and that sort of started a big drop off for Tesla. But they also had, they had a small beat right before that. It was that jump right there. And so the stock moved up slightly on that. But then, of course, we had the Twitter drama, and we were a little bit downward for Tesla for a while there. And then you take a look at July. Over the summer, the stock had a very small movement then. That was because the report came out on July 1st or 2nd, and there wasn't any trading until July 5th. And it really wasn't that big of a difference as far as what Wall Street had been expecting to what actually happened with the numbers. Now, more recently, Tesla has fallen pretty significantly. So if you take a look here over the last year, you'll see Tesla had a big drop in October. That October drop, it dropped about 10% that day as Tesla missed on deliveries. And then most recently, in January, Tesla also had a big drop, fell about 12% intraday, also having a big drop that day because they missed by about 15,000 cars, I should say. Now, the Bloomberg consensus estimate, Shauna, for this weekend, or what we expect to come this weekend, is 421,000 vehicles. So that will be the number to watch. You take a look, too, at Tesla year to date, we should note, has been on quite a wild ride, up about 70%. So it's been positive for the stock so far this year. This will be one of the key catalysts to see what happened with those price cuts, right? We had all the price cuts this quarter. Did more people buy? Did they sort of meet what was expected to be increased demand because of the price cuts?
Yes, certainly. Very significant implications for the stock, especially given that massive rally that we've seen. If we do see a miss, we could be looking at losses on Monday. All right, Josh Schaefer, thanks so much. Well, Tesla on track for its best first quarter performance ever as investors bet that recent price cuts are going to boost demand. But will Tesla live up to those expectations with its Q1 delivery and production numbers? We've got Tom Narayan, RBC's global autos analyst. Tom, it's great to see you again. So the big question, and Josh just alluded to it, is whether or not those price cuts that we saw from Tesla, if they worked. What do you think?
Yeah, we definitely think they're working. You're seeing it in the stock reaction today. We actually forecast a number of 445,000 units. So it's actually even better than that Bloomberg estimate you quoted, 420,000. And we've actually tracked using the app download data, which we've scraped, and that corroborates our finding. It looks like the price cuts are definitely working for these guys.
So, Tom, if they're working so well, should we expect more price cuts there than when we look out to the remainder of the year, given the fact that consumer spending, we're starting to see some of a pullback and lots of questions just about what the economic picture is going to look like?
Yeah, it's kind of like a chicken and egg thing, right? So if you're seeing that the demand is there and people are buying the cars, then you don't really need to cut prices as much. So, maybe they did most of the price cutting already and they may not need to. If the demand wasn't coming, then maybe then they would have to cut pricing. It also depends on which region you're talking about. I think China is really where the price war is playing out, but they've held on to market share pretty well, while a lot of other automakers, incumbents, are losing share. A lot of that is because of the price cutting. So as long as they can kind of maintain or gain market share like they have been without cutting more pricing, maybe they don't need to. We forecast like a 9% aggregate price cut throughout the year. And we've shown that actually, even by doing that, profitability isn't really compromised as much as you would think.
So, Tom, we have certainly seen a very, very strong start to the year when it comes to Tesla, up nearly 70%. Has that jump been justified, do you think, and enough here to keep that momentum going?
Yeah, I mean, this is definitely that kind of stock, right? A lot of people aren't really looking at Tesla and looking at its valuation. They're really looking at how it's performing and executing. As you guys noted, it really comes down to deliveries, and these delivery numbers have shown that the growth is really coming. But yeah, I mean, you can actually even so make a case for a valuation, even in that case. If you just look at Ferrari, a stock that trades at 25 times EBITDA, which is our price target multiple for Tesla, you could get to a $223 price target. And you could arguably say that, yeah, Tesla is growing even faster than Ferrari, 1.8 million units from 1.2, potentially to 3 to 4 million units in the future. And its profit margins, we heard from the Capital Markets Day, could explode by cutting costs by half. So I think there is an argument you could make that the stock could run further. And it really comes down to execution, like things like we're just noticing, we'll probably notice on Monday when we get the delivery numbers and what we anticipate to happen.
Tom, there's a report out today that Elon Musk is planning a trip to China as early as next month. What's your gauge just in terms of what the demand picture looks like specifically in China, and what you think Tesla needs to do in order to further push into and gain even more market share there?
Yeah, the Chinese market is getting way more competitive, especially from the domestic players. You're seeing a lot of market share gains from BYD, for example. A lot of the incumbents, like Volkswagen, notably, are losing share, especially in the full electric space. A lot of it comes to what the consumer wants in China and what they're demanding more and more, especially in that kind of mass market, slightly below premium segment, is connectivity and software. This is where some of the incumbents are losing out, notably Volkswagen. But if you look at Tesla, that's where they shine. It's really on connectivity and software, and they're gaining market share along with the Chinese domestic players, while a lot of the other incumbents, especially in this full electric space, are losing share.
Tom, when you take a look at the EV pickup division right now, and I bring this up because Ford just yesterday saying that it's raising prices once again on its F-150 Lightning, and lots of talk, lots of hype, I should say, about Ram debuting its EV pickup truck, or we're getting more information on it next week at New York's Auto Show. What do you make of the competition right now within the pickup truck EV landscape, and who do you think is going to come out on top?
Yeah, I think this topic gets a lot of attention for great reasons. A lot of people want these vehicles. But if you really look at the pickup truck space, it is dominated by internal combustion vehicles. A lot of these are for small and medium-sized businesses. So I think it is getting a lot of attention. But really, if you look at the penetration of the electric pickup trucks, it's de minimis, right? And in the U.S., electric penetration is going to take a long time to really go anywhere. You really have the big Detroit three. They're all going to have compelling products. Ford did launch its product earlier than everybody else. It's kind of took an ICE car, its regular F-150, and kind of made it electric. Whereas what Chevy and what Ram are going to do is really make a dedicated truck, which will be potentially more compelling. And then, of course, Ford will come out later with something that's competitive as well. So I think all of these will be competitive products. But at the end of the day, these are, I think it's a lot of headlines. Pickup truck electric penetration is going to be really low for a while. But yeah, maybe one day it'll be more significant. But right now, I think it's just getting a lot of attention in the news.
All right, Tom Narayan, always great to get your perspective of RBC. Thanks so much. Have a good weekend.
You got it.
Before we go to break, let's do a quick check of the markets, and this is sponsored by Tasty Trade. Once again, you're looking at gains across the board. The Dow up almost 400 points, S&P up just over 1%. The Nasdaq also continuing to outperform. All 11 of the S&P sectors trading to the upside. A lot of the sentiment, a lot of the risk on that we're seeing in today's market action coming after that better than expected inflation print this morning. Consumer discretionary by far the outperformer today, followed by communications services and materials. All right, coming up, GM is phasing out Apple CarPlay in its EVs with the help of one of the tech giant's big competitors. We've got the details for you next. It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. Ali Garfinkel joining us for the first time on Triple Plays. Let's get to it. We have GM and Apple, Meta, and Digital World Acquisition Corp. Let's start it off with my pick today, and that's GM and Apple. GM reportedly planning to phase out Apple CarPlay and teaming up with Google instead. Starting with the 2024 Chevrolet Blazer, the automaker is going to use its own infotainment system that is developing with Google for future EVs. Why are they doing it? Well, the thought here is that they are going to have access to more data in terms of where you're driving, and also some of that charging data for the EVs. Now, this is a big reversal for GM, who went all in on Apple CarPlay just a few years ago. Right now, Apple CarPlay, as well as Android Auto, really lets drivers bypass a car's infotainment system. Potential backlash here, what's going to be discussed is that maybe it could alienate some iPhone users because people who have used CarPlay absolutely love it.
So I've got to tell you, Shauna, what I'm hearing here is on one hand, Apple's ecosystem. That ecosystem is expanding. I feel the tentacles of it reaching out far and wide, right? And that's what the street wants. That's what Apple wants. It's why people, for instance, think they're going to be successful in VR. However, as an Apple user, as an iPhone user, I'm like, what am I going to do with CarPlay? Right? Like, what do I, you're having a thought, Josh.
Well, what do I shop
Apple
around
TV?
more for, my phone or car? and I just buy an iPhone every time I'm going to get a new phone, right? Versus cars, I don't know about you guys, you should go and drive a couple models, right, from a couple different brands and try them out. CarPlay to me and Apple CarPlay to match up with my phone is an added bonus when I'm driving around those cars. I'm wondering if GM is putting itself in a corner here that maybe it didn't intend to, and if some Apple users are gonna say, you know, I can get CarPlay with a Ford or whatever the other brands are that would offer that, and if it actually hurts GM in a way.
Yeah, and I don't know what really is going to be special about Apple CarPlay, really. I think we'll have to see. Now, we're going to go on to my pick, which is Meta. The company's AI unit released some key research today illustrating advances in applying AI to robots. Some of the most challenging problems in AI involve things like balance and coordination, things like how can you teach an AI-based machine to learn from the environment around it? And Meta, in its case, says it's starting to answer some of these big questions by building systems that allow robots to learn from both real and simulated human interactions. Though this is thorny for Meta, right? They're trying to keep a lot of plates spinning on their part, and more broadly, there's a lot of AI backlash out there right now, including from big names in tech like Steve Wozniak and, of course, Elon Musk.
Some of the thorny parts here seem to be that they're releasing this data open source, I believe, right, to everyone, and I think that that's sort of what Musk and others have been warning about, is you're now putting out this AI data, essentially how you're teaching these robots to act like humans, out to everyone to grow and learn from, which is normally a good thing in the technology space, but I think it sort of feeds into what the fears are here of we're now teaching everyone how to build robots that might be more powerful than we thought.
And remember, it's not their robot, it's Boston Dynamics' robot, right? So it's the sort of thing, well, what does Meta own here, really?
Well, yeah, but I also think for them, it's so smart because we have certainly seen the investor reaction to when Mark Zuckerberg has mentioned AI. And he has had a very, very tough time getting investors on board with his vision of the company over the last year and a half. He mentioned AI, back in February, and you could see that instant reaction in the stock price. So for them, making it seem like they are pushing further in AI, investing more in that space, obviously something that will get investors excited. But you're right, when we talk about so many of the issues that are related to AI right now, the calls here for more regulation, what exactly that should look like, there's a lot of hesitation, and I'm kind of there. It does scare me a little bit with an AI robot.
The ticker symbol's already taken this time, Zuck, sorry.
Yeah.
For now.
Keep leaning in, though.
Same thought.
Maybe we'll get AI verse soon. My play today is Digital World Acquisition Corp, DWAC. Shares of the Trump-tied SPAC are in the green once again, and trending on the Yahoo Finance website as the former president is indicted by a New York grand jury. Now, DWAC is a blank check company and is expected to complete a SPAC merger at some point with Trump Media, the parent company of Trump's Truth Social. We've seen moves like this in the past, and really where this sticks out to me, Shauna, is Trump has been, as this process has been going on over the last week, months, he's using, I want to say tweeting because it feels like Twitter, he's posting a lot on Truth Social. And we've heard from political strategists earlier in the hour that this might mean that Trump is still continuously well positioned for 2024. If you think about if he gets back in office and he continues to use Truth Social, does that become a bigger thing? Are we now using Truth Social to see what he's saying the same way we used to use Twitter to see what he's saying? I think it's sort of an interesting spin here. With Trump back in the headlines, I went on Truth Social for the first time in my life today.
Yeah.
So they got me.
No, that is certainly a very, very good point, and we can certainly see that the trading action of this stock of DWAC has certainly been tied to any sort of headline with regards to Trump. When the GOP did not capture both the House and the Senate in the midterm elections, we saw DWAC come under pressure. So yes, the fact, and you're exactly right, what Rick Wilson was saying at the top of the show, that he thinks this is going to add to the support, drum up, really rally his base, solidify the fact that he will be the GOP nomination in 2024. If you're looking at it from an investment standpoint and what it means for this stock, you would have to think the shares would then be trading much higher. But you're right, they're down 90% or something like that.
That stock was almost $100 at its peak. I think it peaked at about $97 a share.
Yeah, certainly a name to continue to watch here as we do continue to obviously cover Trump over the next 2 years. Well, coming up, our very own Jen Schomburger sat down with Director of the Consumer Financial Protection Bureau, Rohit Chopra, on the fallout from the collapse of Silicon Valley Bank. We've got that for you on the other side of the break.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. With the recent failure of Silicon Valley Bank, consumers are questioning the safety of their deposits, while lawmakers and regulators are assessing how to prevent a failure like this from happening again. Joining me now in an exclusive interview is the director of the Consumer Financial Protection Bureau, Rohit Chopra. Director Chopra, thank you so much for sitting down with me and having me here at HQ.
Thank you so much. It's great to be with you.
I want to kick off the conversation and ask you about the health of the banking system now. What stresses, if any, are you seeing in consumer finance markets right now?
Well, obviously, the last several weeks, we saw quite a bit of anxiety from so many people in the country about whether their deposits are safe, and they are. We've been looking very carefully, though, to make sure, are there other places where consumers can be harmed or taken advantage of on all sorts of products and services? So right now, we're not seeing any uptick in any major product area, but we are certainly not taking our eye off the ball. When financial systems, they're all very fragile, and one little pinprick often can lead to all sorts of harm for individuals. We saw that in the last financial crisis in 2008, and we are very on guard to make sure that people are protected.
There's still a lot of question marks as to why Silicon Valley Bank failed, and for that matter, Signature and Silvergate. What do you think were the major causes?
Well, in many ways, it's similar to what we saw in past crises, panics. There's a mix of managerial incompetence by banks, but also places where the regulations may not have been where they needed to be, and the regulators not always taking the steps they need to do it. We're obviously doing a review to see what went wrong, but there's no question in my mind that several years ago, there was deregulation that occurred, assuming that banks of a certain size would not create risks to the entire economy. And that fundamental assumption was wrong. Even though Silicon Valley Bank may be just a fraction of a size of, JP Morgan Chase, Citi, Wells Fargo, it still was giant enough where its failure could have led to really serious consequences. So I think that's such an important data point, and we now need to use that fact to really help fix the system so this does not happen again.
And to your point, you actually warned about the risks posed by banks with $100 billion or more in assets. You called them systemically important last year. What needs to be done to prevent a failure like this from happening again? You spoke about regulations. How do regulations need to be changed for banks of this size, given the issues that ensued?
Well, it's really tough to call some of these banks small or smaller. They're still very large and much larger than the thousands of local banks in the country. So there's just some basic safeguards that you always want. Bankers and their shareholders, they've got to have some skin in the game. That means they've got to hold the right amount of capital. There's got to be some real accountability on executive compensation so that they don't take out of control risks. They've got to have the cash on hand to meet when depositors want to get their money out. These are common sense safeguards that we need to make sure are in place, especially to avoid catastrophic effects of one or more of their failures. We had to take extraordinary measures to contain the damage of the failures of Silicon Valley Bank and Signature, but we need to make sure that we're really learning from this and taking the right steps to prevent it.
Social media seem to play a role in the speed of this. So to your point, given the new reality that we live in, do we need a certain level of liquidity and capital to prevent a failure happening in such short order that we saw?
Yeah, it's a good point. Communications are so much faster. Banking is much more 24-hour. There's more real-time payments. That's just reality. We're not going to be able to turn back the clock on that, nor should we. But it does mean that bank runs can happen more rapidly. They can happen in ways that are overnight. And we need to take that reality into consideration when setting up the right type of oversight and rules. You know, at the end of the day, banks are really the plumbing of the economy. And when they're not working well, our whole society suffers. And that's why it's so important to get this right.
I want to ask you, FDIC Director Martin Gruenberg is reassessing, conducting a review of the deposit insurance system in this country. He's expected to have a report out by May 1st. Given that you actually sit on the board of the FDIC, how do you think deposit insurance needs to be reformed? Should we be raising the level of deposit insurance?
I don't have any firm conclusions on that, but I'm certainly very open to that. But that can't be the only thing we do to address this. I would not want the end of this to just be changes in deposit insurance. It is very clear that we need to beef up the oversight and really look hard at those regulations that were gutted a few years ago.
Also this week, we heard from FDIC Chair Gruenberg. He testified before Congress, and he was asked whether community banks should be exempt from having to pay for Silicon Valley Bank's failure. He said that the FDIC does have discretion, but ultimately it's up to the board to make that decision. Again, since you are a board member, what's your thinking on this?
Yeah, I agree with him. I think the law tells us that we've also got to look at the institutions that benefited from some of those emergency actions. I think it would be hard to say that community banks played a role in causing this. If anything, they are offering a safer way for the system to operate. So I think that's right. I think we have to take a hard look about whether we limit or exempt the smallest and safely operating banks from having to pay for this.
Director Chopra, thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
All right, thanks again.
That was Rohit Chopra, Director of the Consumer Financial Protection Bureau. We'll be right back after this.
The anxiety and fear that gripped the markets following the recent banking turmoil seems to be easing, at least for now. A new study out by Nationwide Survey found that despite some of that fear subsiding, 40% of women still worry that we are in a financial crisis, and 87% of women feel that there is no proper way to prepare for a recession. Let's try and change that and get our viewers' retirement ready for that. We want to bring in Christy Martin Rodriguez, Nationwide Retirement Institute Senior Vice President. This segment brought to you by E-Trade. Christy, it's great to see you here. So let's take a step back. When we're talking about women getting ready for retirement, especially in a volatile time like this, how does that differ maybe than what we're seeing from men?
Yeah, so a couple things that are facing women that are so prominent. The first, think about our longevity. So a woman's life expectancy is about 8% longer than a male. And then we often see that women have breaks for caregiving, for their children, for their loved ones as they age. And so that is really some kind of prominent areas that have prompted women to really have to think about and contend with. One of the great findings that we also heard from the study was 87% of women are actually now understanding that they're going to have to think about income supplements or a way to work during their retirement years, as longevity will play a critical aspect of that.
And what are the biggest challenges facing portfolios right now when you're trying to figure out how exactly to allocate your retirement savings, especially in a time like this? Why is it so critical to really reassess?
Yeah, it's important to reassess because we're dealing in a market now that is very volatile. And I think we all can agree with that. We just have the segment around the banks as well. But it is ways that women can really combat to that. So some of the things that we found in the study that women can do, and quite frankly, men, is that a good proportion of them are saying, I'm spending less. I'm being much more frugal and making decisions around what I really need to purchase in the next 12 months. And is it necessary? They're also being extremely strategic about their long-term savings portfolio. And one of the things that I really love that women are doing is we're seeing a pivot or a shift in their saving strategy. And we're seeing a lot more women address having a financial professional. And we saw that almost a 10% increase year over year. So it's really about how do you think about your strategies, not just short term, but long term, and really saying, do I need to tap into my retirement savings, which is something we strongly encourage women not to do, to that earlier point around longevity. And we're really seeing now more than ever that women are actively involved in understanding what's going on, and not only our local national environment, but our global environment, and taking the necessary steps to move forward and to be prepared.
And Christy, when it comes to putting that money away, what are the best vehicles? Where should women specifically be looking when they're trying to gauge the best place to allocate their savings?
Yeah, I kind of break it down really 5 key ways that women can do this. The first is, number one, if you have an employer, meet that match. That is so critically important to leverage the match that you have with your employer. Invest in the long run. Right now, we're in what we potentially believe is a bear market. So this is a perfect time to get into the investment in the stock market and invest now for the long term so that money can continue to grow. They say the best way to beat the market is the timing in the market. And so we really encourage women to do that. And we truly believe this isn't an all or nothing game. You can certainly have a portion of your money that you're meeting and addressing some of those short-term needs, but also not compromising what you need to do in the long run. And then just very much like you have an annual physical review, we encourage women, sit down and think about your investment strategy. I can say as a proud Gen Xer, my investment strategy is totally different than when I started in my career, and making that very important to do so. And then the last, just like you would see a doctor or a specialist, if you can, try to engage with a financial professional or advisor to help you navigate through some of these things and also manage some of the discussions that we just mentioned.
Very important things to consider. Christy Martin Rodriguez, thanks so much for joining us. Have a good weekend.
You too. Thank you.
Thank you. All right. Well, coming up, we are in the final minutes of trading here for the week and also for the first quarter. We are counting down to the closing bell on Wall Street. Stick with us. Just under 30 seconds here until the closing bell. Let's take a look at where things stand right now. The Dow up 415 points. You're looking at the S&P up just about 1.5%. The Nasdaq, the leader today, and that has really been the case over the last 3 months. The Nasdaq up about 15% since the start of the year, and that rounds out the first quarter of trading. And you can see ringing the closing bell right there, Giannis Antetokounmpo. He is teaming up with Calamus Investments. Dave Briggs is going to be talking to him on the floor of the stock exchange in just a few minutes, so you don't want to miss that. Let's get another check here of the markets, sponsored by Tasty Trade. Again, all three of the major averages closing in the green. Dow up just over 400 points. And as we officially wrap up the first quarter, let's take a deeper dive into the performance that we've seen. Jared Blickery crunching all of the numbers for us. And Jared, tech a clear winner here over the last couple of months.
Yes, it really was. Here's today's performance. Let's drill down into the major indices first, and then we'll get to the tech trade. Here's the Dow. Year to date, guess what? It closed up a whopping 38 basis points. That's less than 1%. The Nasdaq was the high flyer, though, up over 16%. And then the S&P 500, a little bit less than that, 7%. Let's call the split the difference there. And finally, the Russell 2000 just up barely there. Russell 2000, that's the small caps, no big tech in there. So let's take a look and see what happened. This is a sector action on a year-to-date first quarter basis. Tech, that's XLK, that is in the forefront, up 21%, followed by communication services and then consumer discretionary. All of these are outperforming the S&P 500, and that's it. And guess where those stocks are? They are right on the left side of the Nasdaq 100, where we're seeing some really outsized gains today. Look at this. Apple up 27%, Amazon right on its heels, Meta 76%, Tesla 68%, NVIDIA crossing 90%. Really incredible gains here, especially leading into the close today. And let's take a look at the Dow as well. We can see, well, not the same thing as the Nasdaq. Obviously, a lot more red here. You're going to see some pharmaceutical names like J&J and United Health. Those are down 12 and 10% respectively. Some staples in here. But then the tech trade in the Dow looking pretty good here. Apple, we went through that. Microsoft up 20%. Salesforce down here, that's up 50%. And if we take a look at some of our leaders and sentiment indicators, guess what number one is? Bitcoin, BITO ETF. We're going to talk with Dave Hollerith in a second here. But secondly, we got ARK Innovation, then meme stocks, then chip stocks, then internet stocks, then software, then IPO, then gambling. Pretty big fringe investment area represented on the top line there. What's at the bottom? KRE, that is a regional bank trade. That's down 25%. Not a big surprise there. Also, MJ, that is a cannabis ETF. That is down 17%. Let me take a look here at the banking sector. We know there was a lot of carnage. Credit Suisse really taking the brunt of that. That's down 70%. The square is so small here. Well, the little rectangle, hard to see on this, but you can see in the U.S., pretty bifurcated market. You got Bank of America down 13%, HSBC up 9%, MS, that's Morgan Stanley, up 3%. But when you take a look at the regional banks, it's just a sea of red, not only red, dark red, and just some really jaw-dropping losses here. Look at the bottom row. The least bad shirt in the laundry basket, that is down 35%. And then it goes all the way down to just about a total wipeout there with SBNY. That's Signature Bank. That's down almost 100%. We're going to round that. And then let's take a look at the meme stock trade. We did have some motion in a lot of these stocks. GameStop up 25%. Coinbase up 90%. That's kind of the Bitcoin trade. So interesting to see how all of this fit together. And then some of the well, I don't want to call them losers here. I did want to check out the pharmaceutical trade because that was also mixed. Did well last year, and you can see more red than green here. Shauna.
Yeah, certainly. Some of those bigger names, Pfizer, off just about 20%. All right, Jared, thanks so much. Let's talk about another big winner in the first quarter, and that, of course, is Bitcoin. It has certainly been on a massive run to the upside, climbing more than 70% since January 1st, and Ethereum not too far behind, up just about 50%. We want to bring in our crypto reporter, David Hollerith. And David, when you take a look at these massive gains, lots of questions just about the biggest driver here and whether or not that's going to continue.
Yeah, Shauna, that's always the question. The crypto market, I think the story here is that it's had no real issue shaking off the value destruction that we saw last year. I mean, but that being said, in the U.S., the asset class isn't exactly away from facing challenges. Bitcoin stole the show, and it closed out the quarter above 70%. It's leading other major cryptocurrencies by about 10%. It's also sort of broken away from its correlation with the Nasdaq, which it typically is pretty high in correlation with, though it's still moving in sync. They're both up, obviously. And just for the wild rise, it sort of started in January for Bitcoin. It rose about 40% above $20,000. And then it kind of fluctuated between 20 and 25. And we saw the voluntary liquidation and involuntary liquidation of Silvergate and Silicon Valley Bank, and then also Signature Bank happen in March. During that period, Bitcoin slipped below $20,000, sort of in between Silvergate's message of winding down and Silicon Valley Bank's news of seizure. So that was sort of the moment of panic. And after that, the major cryptocurrency it's just been flying. It's up another 20% from that time, or excuse me, it's up another 30% since that time. And while the bank failures have definitely shown that bank stocks are kind of the area that's hurt right now, the two major banks that did fail, Silvergate and Signature, or that wound down, that is reduced liquidity for major cryptocurrencies and trading. And what that basically means is that the price is a little bit more easily influenced by buy and sell orders. And that's especially true over the weekends. That's what we've seen. Other cryptocurrencies I'll point out, XRP, which is currently sort of on the home end stretch of being ruled as either a security or something else in its related court case between Ripple Labs and the SEC. It rose about 57% through the quarter. And then the second largest cryptocurrency, Ether, rose a little more than 50%. And that one's a good one to keep an eye on, as it has a new upgrade coming in the coming weeks in April. That's the Shanghai upgrade. Shares of Coinbase have also moved fairly similar to the cryptocurrency asset class. Moving along with Bitcoin, Coinbase is up. It fluctuates even more than Bitcoin, at least today, but it's up more than 70% from the last I saw it. On all of those notes, though, I think I'll also point out, just in general, in the U.S., there's still been no shortage this quarter of regulatory tightening going on. So it's interesting to sort of see this split continue between sort of what's happening with regulation, which is uncertain, and then the asset class, which is obviously moving pretty well right now.
Moving very, very well to the upside. All right, David Holler, thanks so much. Well, former President Trump has been indicted by a New York grand jury. It's the first time in history that a former president has been criminally charged. How is this going to play out on Capitol Hill, and will it affect the 2024 election? For more on that, we want to bring in Tobin Marcus, Evercore ISI Senior U.S. Policy and Politics Strategist. Tobin, it's great to see you here. So let's start with what this means on Capitol Hill. How do you see this playing out, just in terms of how the GOP is going to react to it, and also what it means in terms of a response from the Democrats?
Yeah, absolutely. So it's pretty clear already that the party is going to rally around former President Trump. This has been most clear from House Republicans, who have always been his kind of staunchest base. Within the congressional Republican wing, senators have been a little bit more skeptical of President Trump. Generally a little bit more eager to maintain their distance. So House Republicans have come out swinging. They're demanding hearings, testimony from Manhattan DA Alvin Bragg. A lot of that, of course, is just making noise, making a show of their support, but certainly no sign that the party is turning against him there. And I do think that they will look for opportunities to try to portray this as a political investigation. They certainly have already leapt to characterize it as weaponization of law enforcement and sort of inappropriate targeting of President Trump. And I fully expect that they will continue hammering those messages really hard. Democrats, in turn, I think have pushed back, as you'd expect them to, but it's not something that I think they're quite as eager to make noise about, not least because I think the soft consensus in Democratic circles is that this is not the strongest of the cases against President Trump, not necessarily the one that you would want to lead with. And so I think that probably they're not trying to, sort of go to the mat or stake their reputations on defending this particular case. Not that they think that there is anything inappropriate that's happening. They obviously forcefully reject the Republican claims that this is kind of weaponization and targeting. But I don't know that this is the thing they want to focus the political system's attention on.
What about obviously what this means for the general election? We talked to a political strategist in the last hour saying that he thinks it might actually help the Democrats, might help some people swing and vote for Biden. Do you agree?
Yeah, I mean, I think this is probably a benefit for Trump in the primary. I think that now is kind of conventional wisdom. It's something that I've been saying for a while, but certainly you look at how the party's rallied around him, and it's hard to disagree with that. In the general, though, I think it's pretty clear that this is a liability. The kind of witch hunt messaging that Trump loves to lean on plays very well to his primary base. I think a lot less so with swing voters in the center. And we saw in 2022 a fairly clean test case of how moderates and independents and swing voters react to these kinds of Trumpified candidates that the Republican Party nominated in a lot of Senate races, who are really focused on kind of relitigating the 2020 election and other sort of hobby horses of former President Trump. They did very poorly. Democrats won, independents by 2, which is fairly uncommon in a midterm election for the president's party. And I see no reason to believe that we'd get a different reaction, when the Republican candidate is facing one or potentially multiple indictments next year.
Yeah, Tobin, that's a very good point here. When we talk about a divided Congress, if more GOPers here come and back and continue to back former President Trump, what does that mean just in terms of reaching any sort of bipartisan agreement over the next 2 years? Obviously, the Congress was already very divided before this indictment. Any hope here of bipartisan agreement? Is that now hope? Has that been dashed?
I don't think it makes a big difference one way or another. I think that for the most part, the bipartisan legislating that we're going to see over the next 18 months before things fully turn to the 2024 election is going to be under duress. That we will need a bipartisan resolution to the debt ceiling over the summer. After that, we'll need bipartisan bills to fund the government, to do the kind of annual defense policy setting that Congress is very committed to. And then there's a few things that have an outside chance of getting done. The TikTok ban proposal is certainly something that's in the mix, although I'm less convinced about how much momentum that has than some analysts. But even those, I think, are probably going to have to ride along with one of those very few pieces of must-pass legislation that have a chance of getting done. So not a lot of room for kind of elective bipartisan deal-making and legislation anyway. And some of the things that have to get done essentially regardless of how much bad feeling there is between the two parties. So I think probably not a big influence in either direction there from the polarization around Trump here.
All right, Tobin Marcus, always great to get your perspective. Thanks so much for joining us. Coming up, NBA superstar Giannis Antetokounmpo teaming up with Calmus Investments to help people better invest for a brighter future. He just rang the closing bell, just a few minutes ago. He's going to join us live with Dave Briggs from the Stock Exchange next.
That was two-time NBA MVP and NBA champ Giannis Antetokounmpo ringing the bell here at the New York Stock Exchange just a short time ago. How about that? The NBA superstar for the Milwaukee Bucks is now partners with John Kadunas, the president and CEO of Calamus Investments, on what they call the Sustainable Equities Funds ETF SROI. Calamus and Antetokounmpo Sustainable Equities Funds ETF. They are 50-50 on this project, and they join me here live at the exchange. Good to see you guys. Good to see you. Giannis, I know you always say you can't forget where you came from. So being that you came from selling handbags and glasses on the streets of Greece, what did that mean to ring the bell on the New York Stock Exchange?
Unbelievable experience. Just being able to be with people that I work with and have my family here to experience this with me. It was pretty awesome. You know, seeing the banner outside coming down, that was a great feeling too. But you know, I'm here with a lot of hard work. A lot of hard work that paid off. You know, I can't stop now. I got to keep on learning, keep on educating myself, and you know, try to keep on giving back.
Your investment journey's been an interesting one. You had the Milwaukee Brewers, you had the Nashville SC, so you go MLB, MLS, ESG, ETF. How did that become your next journey? Why is this the right opportunity?
Because we share similar values. You know, we want to, you know, create a platform for people to invest their money, and we want to, as I said, give back. We want to educate people about financial literacy.
John Kadunas, the CEO of Calamus Investments. I think you just answered this, but why is he the right partner for you, John?
Well, I met Giannis about 1.5 years ago through a mutual friend, Mark Lazary, who you know, the owner of the Bucks, and we hit it off right away. And like he said, we had shared values, family, community, environment, you know, so education, and I just brought in and hired an incredible ESG team at the same time. And things were just like, you know what? This makes a lot of sense to do a JV together with someone that has the same values, that we can leverage both us as being great investors and Giannis for, you know, the soapbox that we have, the ability to send a message out to invest in ESG right now.
ESG has become a political hot button across the country, as you know. It also comes at a time where ESG outflows have been big. The biggest ESG ETF in the world saw $5 billion in outflows in March. Why is this the right time to be in that space?
ESG is not a fad. It's here. It's going to stay here. And if you look at the actual numbers, there's been some outflows, but last year, or in 2020, there was about 35 trillion in ESG. 2022 at the end was 43 trillion. They're predicting 53 trillion by 2025, which is more than a third of all investable assets. It's not a fad, it's here. Other parts of the world are a lot more advanced than the United States is in this. And so if we can get a team to outperform the S&P and still be ESG, we have a winner, especially with someone like Giannis on the team.
Someone like Giannis, whose investment journey started when you spread your money all around in numerous banks to stay under the FDIC deposit insurance level, which given recent events actually was a stroke of genius. Some laughed it off, but that was actually brilliant right now.
I was ahead of my time.
You were, absolutely. You saw this coming. Who then stepped in and taught you about investing? What was the most valuable lesson you learned?
Money makes money faster than people can. But I want to explain this story. You know, obviously coming from Greece, I went to Milwaukee when I was 18. I didn't know how to invest my money. It was the first time I had a lot of money, and you give an 18-year-old millions of dollars. So I wanted to educate myself. I wanted to put people around me to tell me and guide me through the journey and how to make something out of this, right? So when I went to the bank, I gave them my money, and they told me just to know that we only insured 250,000. And I said, oh, wait a minute. I definitely do not want to go back where I came from, you know, and go back to the life that I had. So I'm like, okay, I'm going to spread it around banks. So I had 5, 6, 7 banks. But there's way more smarter ways to do it, that you can keep your money safe. And I've had people, I've created an entity with my brothers and people that we brought around under Inc. that invest my money for me.
Financial literacy is part of this journey for you. Part of the profits will go to financial literacy. What's the lesson you want your two kids and those millions of kids out there that do idolize you? What do you want them to know about investing and about saving?
Don't be scared. I feel like my father installed into me the fear of, because they didn't have money. The little they have, they rather kept it underneath the mattress and just keep it at that. You know, be courageous, take the risk. You know, allow your money to work for you. Go out there, invest in things that you're passionate about. Invest in things that you're interested about, you want to learn about, and you want to get yourself involved with. I hope my kids can do this at the early age, because I did it when I was 25, 26.
Okay, you said don't be scared, so I'm going to follow your advice. I'm a little scared, given our obvious size and strength difference, to ask about last night. You guys lost by 41 to the Celtics. Do you learn more from your failures, from your losses on the court and off the court, than you do your victories? And what do you learn from them?
Definitely. In victories, you become comfortable. You excel more when you face adversity. And obviously, they're a really good team, and now we got to play better. Last night was last night. We got to focus in the present, and hopefully next time we play them in the future, we are ready and prepared for them. But we have to get better. We have to get better. We cannot get comfortable because we won a championship 2 years ago. We have to keep on getting better, keep on learning.
He's chasing his second NBA title and a third MVP. He's Giannis Antetokounmpo. John Kadunas, President and CEO of Calamos Investments. Best of luck in the journey, SROI. Thank you, guys. We'll be right back with the latest entry into the buy now, pay later space from Apple.
Apple is shaking up the buy now, pay later industry, unveiling its long-awaited plans to enter the space earlier this week. And that was enough to send Affirm and PayPal shares lower, both initially taking a hit on that news. Paul Golding, Macquarie, a U.S. lifestyle and payments analyst, is here with us to talk about the impact of Apple entering the space. And we also have Yahoo Finance tech reporter Dan Halley joining the conversation. It's great to see you here, Paul. So let's talk about Apple now in the buy now, pay later space. What does that mean for some of its competitors within that industry?
Well, thanks for having me on, first off. What I would say is that the wallet innate nature of iOS, of having the Apple Wallet on there and this product being managed through that interface, does overcome some of the onboarding or customer acquisition hurdle that you might see with other platforms where an app has to be downloaded. But this is, in a sense, a standalone product, aside from all the credentials that you keep in your Apple Wallet and your Apple Wallet balance to the extent that you use it. And so in our view, while the onboarding may have fewer hurdles, some of the other competing products, which is the context through which we view this, our coverage of Block, for example, and Cash App. Cash App has, in our view, much more breadth to its product lineup. And to that extent, it can not only attract but also retain customers, in our view, around its ecosystem and drive BNPL through that.
Paul, this is Dan. Is there a risk for Apple here, just knowing that, you know, they're being looked at by different regulators around the world as far as antitrust goes, as far as, you know, their control of their platform? This is going to be essentially built in to iOS to a degree. I mean, is that a boon for them as well as a problem?
Well, we don't cover Apple, we cover the payments names. And so I can't speak to the risk specifically to Apple. What I can comment to is something that we wrote about in the context of our coverage of buy now, pay later across Block, and PayPal has Pay in 4 as well. And the commentary from the Consumer Finance Protection Bureau has been that big tech's entry into this product lineup in this product category could lead to some anti-competitive practices. Of course, we're not attorneys to say either way, but that's some of the press that we've seen come out around BNPL, and specifically since this product launched. The other piece of it is the extent to which consumer data is continuing to build through an expansion of product verticals that are aggregated by big tech. And so we have to see the extent to which regulators look at BNPL, BNPL's expansion, and BNPL going up market in terms of company size that's and scale that's offering it, to see what potential regulatory implications this drives on the back end.
And Paul, to that regulation point, our DC reporter Jen Schomburger, she spoke with Rohit Chopra, the CFPB director, earlier today, asked him exactly about that. Let's play a quick clip, and then I want to get your reaction on the other side.
We're hearing lots of stories and seeing some data where consumers are getting in over their head. The existing credit card regulation helps protect against some of this. There's some checks on your ability to pay. There's some credit reporting that helps make sure that things are accurate and above board. There's dispute rights. So we've started the process to figure out how can we make sure that buy now, pay later has those similar types of protections.
So, Paul, some of the similar, I guess, issues or concerns raised there. What do you think when we talk about a potential timeline for this? Any idea about what that could potentially look like?
No sense at the moment from our side. And again, can't speak to the implications for Apple as we don't cover it. But in looking at our other BNPL coverage, we've been hearing similar discussion points for quite a while, and have not seen material action yet from a regulatory perspective, at least in the US. What I will say is that we have seen progressive industry-wide move towards soft checks on people's credit when they apply for a BNPL loan or installment plan. And so that soft check, to some extent, should check some boxes around appropriateness and creditworthiness and other areas that might be of interest to a regulator or lender.
So, Paul, just looking at kind of the competitors in this space, the folks that are already ingrained, right? You would imagine that they would suffer just because Apple is such a big name. And, Apple Pay, for instance, has picked up as far as usage goes. So it's not as though this is some kind of, foreign device to people. I guess for the incumbents in the space, does that allow them plenty of space to still grow in the US specifically? Just because so many people are already using iPhones, that makes it a lot easier. Is there still enough room for the others to grow? Or is it more now an international game for them?
No, we think there's still domestic room to grow, specifically in the BNPL category and overall for their ecosystems. In our view, as I was mentioning before, it's the multiple offerings within an ecosystem that makes them compelling, and then BNPL helps support some of that consumption as well, to the extent that it allows easier payback setup, or allows for a larger basket size, maybe if the consumer would like to make a higher end purchase or a larger purchase, and it's already within that ecosystem. So for example, if we look at a Cash App interface, and we have a Discover tab, and there's a purchase that you'd like to effectuate because you potentially received a promotion for a particular product or service. The BNPL functionality is right there within that ecosystem, that interface for you. And so as the multiplicity of product offerings grows in these ecosystems, same goes for PayPal and for Venmo, there is the potential for the existing ecosystems, BNPL offerings, to become more embedded in how consumers use that ecosystem. So that's a domestic and international opportunity in our view.
Paul Golding, we really appreciate you taking the time. Thanks so much for joining us. Have a good weekend. All right, coming up next, is the metaverse the future, or is it just a fad? We're going to debate. Hallie's sticking around set. Ali Garfinkel's coming in. We'll be right back. Let's talk about the metaverse. Disney, Microsoft, and even Meta pulling back on some of their investments here within the metaverse. But there's still some speculation out there that more players obviously entering the space. Apple might even be one of them. So is the metaverse a fad or is it the future? We've got a showdown of our two top tech reporters, Dan Halley, Ali Garfinkel here. And you guys have differing opinions on this. So we're going to come out. Maybe we'll have a clear winner by the end of the segment. We'll see. Ali, I'm going to throw it to you first. What do you think, a fad or the future, and why?
So I'm going to say it's the future here, Shauna, and work with me for a second. I know metaverse skepticism is very easy, but there are a couple of key reasons here. The first is that kids are into the metaverse. Now, you actually don't need to trust me on this one. We can actually look at some of the numbers. Let's take Roblox, for example. At the end of last year, Roblox had over 26 million daily active users under the age of 13 worldwide. Now, to give you a sense of how big that number is, I believe there are 24 million children in the United States between the ages of 6 and 11. So it's a huge, huge number. So let's start with the kids love it. Second is, for Meta, it's been a chance for them to own their own OS. Meta's gotten a lot of flack for it, but for them, it's been a chance to build hardware that didn't exist yet. And of course, that's something that can help them down the line. Now, owning a bunch of nothing is going to get them nowhere, right? Which brings us to the last thing, that Apple seems to believe in the metaverse. Later this year, they're expected to enter the VR market. And everyone agrees, right, that the metaverse, if it's going to take off, needs that iPhone moment, that hockey stick moment that sends it barreling forward. And who better to create an iPhone moment than Apple, right? Apple also famously is the most trusted brand in tech at this point, I would say. We can argue about that later. And famously, they make things that are easy to use. One of the chief criticisms of the metaverse is that it's so hard to get into, but actually, Apple can maybe change that completely. So that's why I'm bullish.
It's a very, very compelling argument, because I went into this segment, I am not sold on the metaverse. I think I'm going to agree with you. Is it a fad, and why?
I do think it's a fad. It's just, okay, well, let me run down my points and then I can just go for a bigger stroll. But my main points here are that the headsets are uncomfortable. I've worn most of them and they suck. I mean, when you put them on your head, they're heavy, they're unwieldy. I don't care how much people say or Meta tries to sell you on workouts with the metaverse. If you wear something like that on your head and run around, that thing's going to stink after a while. The other thing is there's no killer app. I mean, you can only play Beat Saber so many times, or what's the other one, Job Simulator, so many times before it gets annoying. And cool, I can watch Netflix on a virtual movie theater screen. You know what I can do? I can sit there and watch it on my couch on my 65-inch OLED, which looks infinitely better. And the final thing is, it's a solution looking for a problem. There's no real need for what they're trying to offer here. All of the apps, the games, I much rather play them on my TV or my phone. I have my TV to watch Netflix already. Why do I need something along those lines? I've tried Google Glass. I've tried the Facebook sunglasses with cameras built into them. Snap glasses I've tried. None of it was compelling enough for me to ever want to buy.
But what about Apple's rumored entrance here with that mixed reality headset? Is that going to really change the perception at all?
It could. Look, I'm a skeptic because there's nothing that I want for it right now. Right? I've zero. I could go on about this idea about.
We have talked about this so much off camera. I cannot even begin to tell you. This is a debate we actually have when we are not sitting here with you, Shauna.
That's why you guys were the perfect people to bring on set. We wanted you guys to have the debate right here. Okay, if you had to pick a clear winner from this, if Ali, you are right, and metaverse is the future, who's positioned to win?
I don't know if I can bet against Apple, Shauna. I really don't know if I can. The truth is, if in Meta's case right now, I think I want to say that the market, the amount of market share that they have is about 80% in terms of name recognition. Remember, they did acquire Oculus. That said, I think Apple could make something that's just so easy to use and so much fun and plugged into that ecosystem in a big way that it's hard to imagine.
Very hard to bet against Apple.
It's really hard to bet against Apple on this one for me. It is.
If it does take off, I do got to say Apple. Sure, Meta has
one area of agreement here.
Yeah,
I agree.
I mean, look, they made the smartwatch a thing, right? I mean, they're sure. Meta has the market share right now, the 80%
And you made that
share.
point earlier with the smartwatch. Fitbit was an incumbent, and Apple
Fitbit doesn't exist anymore.
Wipe the floor with them.
If you look at headphones, true wireless headphones, they're all trying to be AirPods. They all look like AirPods, unless it's Beats, which Apple also owns. Yeah, I just, you can't imagine that anyone else is going to be able to do it with the kind of fit and finish and software and experience that Apple is. So, if it does take off, it's going to be Apple.
All right, we'll see whether or not we get that headset announcement at the Worldwide Developers Conference in June, and whether or not Apple is pushing into that space already. Dan, Ali, thanks so much. And Ali, actually stick around here because I know you spoke with the former Disney chair and DreamWorks co-founder Jeffrey Katzenberg earlier today about the future of tech. Did Metaverse come up? What did he have to say?
Metaverse didn't come up, but we did talk a lot about AI, Shauna. I spoke to Katzenberg earlier this week at Shop Talk 2023. And at Shop Talk, it was really clear that the AI hype cycle is just in full swing. And most of the hype, of course, is around generative AI like ChatGPT. But unexpectedly, despite the creativity pieces of ChatGPT, that isn't what Katzenberg is interested in. He joined me with Natomi co-founder and CEO Puneet Mehta to break down why. Take a listen.
I think, like so many people, we look at the opportunities around AI and are genuinely excited about it. I think you're hearing from many of the grand wizards of our world, the Bill Gates, the people who have really been the pioneers in the last generation. I think everybody agrees that this actually may be the next defining moment in sort of our tech evolution, if you will. And with that comes incredible promise. Today, I think the enthusiasm that we're hearing, unbridled enthusiasm, is about generative AI and all of its applications around creativity and storytelling and art, and it really is quite spectacular. That's not what I'm interested in.
There's a particular kind of AI that you are a proponent of, Puneet, sanctioned AI. What does that mean?
So what sanctioned AI means is that you get to leverage all the great things that generative AI brings to the table, but in a fail-safe environment. So you need a safety net around it. You need to be able to enable what role does the AI play? Is it autopilot, where it helps customers autonomously, or is it co-pilot, where it's helping an employee? You need brand safety filters. What are the things it is allowed to say, not allowed to say? You need it to follow business policy and procedure. You need to be able to audit the work that AI has done with relative ease. And then you need escalation procedures where if it does something wrong, how do you have somebody step in and save the moment gracefully? So there are all these things that would apply to employees. Now AI, as it enters your workforce, you have to look at it as an employee. To make it productive, you need all these measures. So sanctioned AI lets you use all the amazing capabilities of generative AI, but for the enterprise in a fail-safe mechanism.
The chaos in tech versus the chaos in Hollywood. You talk a lot about the parallels between the two, and especially at this moment, I'm curious about how you're thinking about those parallels.
Well, I think they're actually quite different. And what I would say on the tech side of it is, if you look at 2010 to 2020, the impact of technology, digital technology across every facet of our lives has been beyond anything anybody could have thought of or imagined. From 2020 to 2030, I think the impact will be 10x what it's just been in this past decade, which we can't actually fathom. That's how gigantic. And so I don't see this as a troubled time for tech. I think it's a time of opportunity for it, and why I'm so excited about it. On the Hollywood side of it, it is a transformational moment in time. And they are in the process of transitioning into a new relationship with their customers. And it's not, I think, crystal clear yet what that relationship is going to be. How important are movie theaters going to be to their customers? What is the place for digital distribution? What is the windowing of content? How much of it? Where? How is it priced? All of those things, frankly, are being redefined in this moment in time. With that, some consolidation going on. And so I think the next 18 months is that time for it to reconfigure itself and have its next renaissance. I couldn't be more optimistic about the opportunities around content creation, content distribution in it. We're watching more television, more film, more video today than we ever have in our lives before in it, and that's not going away. If you are in business today, there are three things that remain essential for your health and happiness and continued prosperity. More, better, cheaper. Right? Those are the three things. Usually,
that all sounds pretty good.
Usually you're told you get to pick two, right?
But you think you can get three?
Yes, I think with AI and the proper deployment of AI, it is going to actually be an opportunity to do all three of those things.
We could look back at this moment, it might end up being the industrial revolution moment for tech, where AI ended up getting us to a place where there were new types of jobs created, there were new types of skill sets, the impact it's going to have on education, on healthcare. But yeah, we are most excited about how the enterprise is going to adopt it and really build that customer connection, that customer love.
I have to say, I really found Meta and Katzenberg's vision of AI almost comforting, because it's really a vision of AI that is not only barreling forward, but is actually safe for brands and for consumers to use. And that's something that we're not hearing a lot about. There's a lot of backlash right now, and it was a really compelling idea, I thought.
Certainly was, and an issue that we know has been brought up even more over the last couple of weeks. Allie Garfinkel, great stuff. Thank you. Well, coming up next, energy drink brand Celsius has more than 2 million followers on TikTok. So how significant would a ban of that potential social media app be for the company? Find out next.
Credit default swaps, or CDS, back in the news, evoking memories of 2008 and the global financial crisis, as well as a Big Short movie, but we're talking about today. CDS contract amounts to an insurance contract on a bond or a loan to protect against the risk of default. That's the credit and the default part, but we want to talk about the swap part as well. And that refers to the exchange of payments or cash flows between the buyer and the seller. Now, when the contract is initiated, the buyer will make an upfront payment plus maybe quarterly or annual installments, and the seller is only responsible for payment in the event of default. That is a credit event. It could be a missed payment on the bond, or it could be the company filing for bankruptcy. Who uses CDS? Probably not you and me, but large institutional bond managers with millions of billions of dollars invested, they of course want to hedge their risk in the market. And for you and me, quite helpful to know what Wall Street is watching and what keeps them up at night.
Let's move on. Chapter 2. Can we please do that?
Bro, you're actually funny. I knew that. A lot of people know that. I'm okay. What's getting me is the actually.
Go ahead. Let's light this candle.
Those are some TikToks there from energy drink company Celsius Holdings, which recently crossed 2 million followers on the TikTok app, and their popularity there is one of the reasons why we have seen that stock soar, outperforming here, up nearly 70% in just the past year. But after lawmakers grilled TikTok CEO on Capitol Hill last week, there's lots of talk about a potential ban, and a new Pew Research poll showing that half of Americans would actually support a ban of the app. So let's talk about the potential business impact of that possible ban. For that, we want to bring in John Fieldly, Celsius Holdings CEO. And John, it's great to speak with you here. Lots of talk about the ban on TikTok, the business implications there. You obviously have a massive presence on TikTok. So what would that mean for your business?
Yeah, I mean, TikTok has been a great platform for us to really connect with consumers and a specific audience in a really relatable way. And as you mentioned, we just achieved 2 million followers, which is a great accomplishment. Actually, we've only been on the platform for about a little over a year now. So, it's a great marketing vehicle for us. Social media continues to evolve and adapt. And on TikTok specifically, a lot of great creators as well. So there's a lot of people making a living on that platform, and which is key to them. In regards to our marketing and initiatives and the way we connect with consumers, we see a lot of opportunities. Further expanding on TikTok, also YouTube, with YouTube Shorts being added, also on Snapchat taking opportunity, getting into the short video. So, there's a variety of different platforms. We got to stay ahead of the trends and where the consumers and the communities are moving to and where they're going. So the key with marketing brands is being agile. So, with Celsius here, we're very agile. And it'll be disappointing if it is taken down, but we'll be agile and move on. But it is a key component, and getting 2 million followers with a core community is something we're really proud of.
John, you mentioned the fact YouTube Shorts and Snap, two other social media platforms where you are seeing a lot of traction. Is that where you are going to go and focus on if TikTok is banned?
Yeah, absolutely. I mean, consumers are spending more time on their phones within these social platforms than ever before. I think some of the latest data that just came out, it's over almost 2 hours a day, 2 to 3 hours a day, I believe the latest data is consumers are spending on these social media platforms, which is substantial. Longer times engaging in social platforms than on TV these days. So it is a definitely way brands are connecting with consumers. You got to be on the social media. I always say own the phone is really critical. So we are engaging on YouTube Shorts, Snapchat, Facebook, Instagram has been key to get the brand out and really connect with more consumers and connect with their communities. And brands are all about community building, and that's where these platforms allow you to really get close to your consumer.
Yeah, John, national security risk, obviously some social impacts from TikTok was kind of the one side that was portrayed while TikTok CEO was on Capitol Hill last week. Is that consistent with what you see, or what is your view of TikTok?
Yeah, I know there's a lot of questions about it and controversy. We see it as a really great way to connect with consumers on a creative way. A lot of creativity, a lot of creative users, and a lot of great fun dancing out there with some short videos. So we have a lot of fun with it. We see it as a great way to engage with consumers on our platform. We have those 2 million followers. We do a lot of great content around the office as well and show people behind the scenes. So we have a lot of fun with it, a lot of exciting times, and we'll move and be agile, which is key. But as it is today, we're having fun with it every day.
Certainly, it's very easy to get lost in that feed. John, I mentioned your stock performance in the intro there. It has been really performing extremely well over the past year, up just about 70%. You've seen some of those gains slip a little bit since the start of the year. What is it that you think is really driving that momentum, and what is going to keep investors excited about Celsius?
Well, we're really excited now. We just put up a record year in 2022, really drove great revenues. We also just partnered with PepsiCo last year, which really started off our distribution partnership in October of last year. We're now the #3 energy drink in the category, and we're in about 90% of all stores around the U.S. and growing exponentially. So really gaining more consumers each day. We have a great product. Great innovative products. I'm drinking a brand new lemon lime flavor. We just launched one of the most refreshing energy drinks on the market that we're told. So tastes great. We're ahead of the trends. We have over 7 essential vitamins with green tea, ginger, and guarana. We taste great. We offer a function, clinically proven functionality, and we're fitness forward position, and all about living fit and living healthy and living life to its fullest. So Celsius Live Fit, it's essential energy for life, and exciting. It's an exciting time for the company and all of our employees and our fans and our followers as well.
I know, John, I wish I had a Celsius here on set. Will really help me get through on this Friday afternoon. You mentioned that partnership here with Pepsi. Any thought just in terms of would you ever be open to a potential acquisition given the fact that your industry is so competitive and you're up against a lot of those larger players?
It is really tough. I mean, we're up against two of the largest brands in all of CPG, and there are truly two monsters ahead of us to say. But it's exciting right now. Where the brand is. We're publicly traded, so I guess we're for sale every day of the week. But at this point, we're working hard. We have a great team behind us. I have over 350 employees growing every day. We have new retailers coming on board, and it's just a really exciting time. The brand, the flavors taste great. It's exciting. Just glad to be here with the team, and our team's working hard. So we're excited for the future.
All right, Celsius shares, like I said, up just about 70% in the last year. John Fieldly, CEO of Celsius, thanks so much.
Thank you.
Well, there has been little relief for consumers' wallets as inflation remains sticky. There's a new Quinnipiac poll out listing the cost of food as a top financial concern for Americans this year. Brooke DePalma is here to break down the findings. And Brooke, what did we learn?
That's right, Shauna. 22% of Americans surveyed said that the most pressing financial concern right now is, in fact, the cost of food. And taking a closer look at the age group that's feeling the impact the most, we're seeing ages 35 to 49, followed by 50 to 64 and 65 plus. And when you think about that age group, perhaps they're the majority of Americans who are doing the weekly grocery shopping at home. And in addition to that, the average age is 36 now for a home buyer, and perhaps they're buying in for home and needing to fill those fridges. But keep in mind, this survey was conducted between March 9th to March 13th. And so this does give us a more recent snapshot of where exactly consumers spending, where their heads are at when it comes to where they're spending their dollars. And this will be a key insight ahead of the next quarterly earnings results. Of course, we're taking a closer look at Walmart and Target, who have heavily invested in fresh food. Of course, Kroger, as well as Albertsons, also a key indicator here when it comes to where Americans are spending their dollars and if they're willing to put up with higher costs of food.
Yeah, and Brooke, when we talk about the jump that we've seen, and really across the board at the grocery store, almost across the board, I should say, where have we seen the biggest uptick in prices?
Yeah, well, this is actually the 6th consecutive month of deceleration when it comes to food prices off those August highs. But year over year, those numbers are in fact staggering. We're seeing double-digit growth when it comes to butter, when it comes to breakfast foods, when it comes to bread, and of course, eggs. Such a heavy topic earlier this year, up 55.4%. But we'll get another key read on where exactly food prices are at as when it comes to March. On April 12th, of course, CPI data will be out then. And so we'll get another read then, a fresh update on where food prices are and how much they're impacting Americans' wallets, that is.
Yeah, Brooke, when you mentioned the price of eggs, and that has been something that has really been gaining, I guess I should say, attracting some of the headline attention because of the massive jump that we have seen. Cal-Maine was out with earnings earlier this week, clearly posting a massive jump in profit. Any relief in sight there?
Yeah, I mean, take a look here. Cal-Maine, sort of what senators saying are making off of these higher food prices. And the avian flu, while we saw a bit of a decline there, they actually said in their earnings report that they have no outbreaks at any of their facilities. And yet we saw record profit of 718%. In addition to that, we saw them uptick in their selling price per dozen. This year, it's $3.30. That's up from $1.61 last year. And what a majority of Americans don't realize is that they're probably buying Cal-Maine eggs. They make up about 20% of retail egg market share. And so once again, not seeing relief too much, up 55.4%. But also a big question here that the Hill and Senate is currently asking is just how much are these companies making when it comes to Americans spending money on groceries?
Yeah, certainly that has been a big issue for a number of lawmakers here over the last several months. Brooke DePalma, great stuff. Thank you. Well, that'll do it for us today on Yahoo Finance Live. Be sure to come back Monday, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Thanks so much for sticking with us. Have a great weekend.